So let's get into today's session and let's get started. So yesterday we saw stronger US jobs data. We saw higher treasury yields, and yet the dollar still can't find its footing. It's like kind of showing up to the gym, lifting really heavy and lifting heavier than expected, and somehow no one notices. So it's the worst. Markets are digesting the delayed January NFP report, and today's theme is relatively simple. We have resilient labor data, we have shifting rate expectations, but we have selective dollar strength. For those of you who this might be your first session with me, good morning and welcome to the Daily Market Brief. I'm Francois, your market analyst here at ATFX Africa. Today we will be breaking down some forex currency, some commodities, and some indices. I'm going to particularly be focusing on USD ZAR, natural gas, and S&P 500. And the big drivers behind all of them is obviously yesterday's stronger than expected US jobs report. And well, we're also going to have a look at what that means for Fed rate expectations going forward. So let's get into it. Let's start off today with USD ZAR because the Rand has been quietly impressive, okay? So the South African Rand is trading around 15 Rand 90 cents to the dollar, which is near its strongest level since June 2020. Now, what is supporting this? Well, first, we have elevated precious metal prices. I've been talking about this for like the last couple of months. And remember, gold, platinum, palladium, this accounts for roughly 20% of South Africa's exports. That matters. Secondly, domestic improvements. We have structural reforms, fiscal consolidation, credible monetary policy, a stable governing coalition, and nearly half of the reforms under Operation Vulindlela are on track, particularly those tracking energy and freight constraints, which should support growth this year as well as next year. Meanwhile, the South African Reserve Bank held the repo rate steady at 6.75%, signaling confidence in meeting its inflation target. In contrast with the US payroll data yesterday, so the NFP report rose by 130,000 new jobs in January, the biggest gain in over a year. Yes, unemployment fell unexpectedly as well to 4.3%. And yes, markets now expect the Fed to have their next rate cut in July instead of June. Yet, the dollar is still hovering near 96.8 to 96.9, round about there somewhere, unable to sustain strong upside momentum. The question now becomes, is USD ZAR just bouncing on a broader downtrend? So we're going to have a look at that on the charts just now. Or is this a more structural shift driven by yield differentials and improving South African fundamentals? Let me know. Drop me a comment. Let's discuss this. Let's talk about this. So, and while you send me that message, let's look at the charts. So here we can see we're on the 4-hour time frame. As always, I am going to drop to some lower time frames just now as well. But so here we are on the 4-hour time frame, and we can see that the 100-period exponential moving average, that orange line right over here, is acting as near-term resistance, currently sitting there at 16 Rand 5 cents to the dollar. So, and then a little bit above that, we've got 1630, which has relatively been about a high point over the last couple of weeks. Was that break we initially saw on the 21st of January, after which we saw a massive sell-off. Markets came back to retest on the 2nd of Feb, sold off again, came back for another retest on the 5th of Feb, and yet again couldn't make it past that level. So now on the downside, this 1565 level, 64, is currently our potential longer term target zone. So if we do get a bit of a rejection, that's kind of the level we are aiming for again. And if that breaks, the next level is obviously that 15 Rand 40 to the dollar. So right now we are much closer to that lower boundary than we are to the upper one, which is that 1660 there at the top, which kind of tells us how dominant the broader downtrend has been over the last couple of months. And I mean, we've been in this downtrend now for quite some time. So I do want to drop down to a lower time frame. So I'm going to drop this down to like a 30 minutes. And on the 30-minute here, you can see there's a relative amount of consolidation. I just want to draw this across. So this is obviously that resistance level that I've been talking about that we've been retesting consistently over the last while. So when we have a look here, so actually, let me use this. This is relatively our consolidation area right now. And again, I'm here on about a 30-minute time frame. Now, I wouldn't be all that comfortable trading within that zone, but it's what happens outside of that zone. So a breakout above this 97, 98 level, even if you want to round it off to like the 16 Rand level, that could obviously trigger a nice little upside momentum for a retest back there at 1660, which would give you a nice day trade. Alternatively, obviously a break here below 1584 to 1583 would give you that short opportunity, aiming back down to this 1550 to 1540 general area. And I mean, regardless of which opportunity market structure provides for us, we will definitely have at least a 1 to 2.5, 1 to 2 risk to reward ratio both ways on the specific setup. So definitely some nice opportunities here on USD ZAR as we are going into the end of the week, tomorrow's CPI, as well as next week's entire trading volume as well. Let me know if you are seeing something different to what I am currently seeing here on my charts. And then let's discuss it around there as well. Robert says, I would say more fundamental to USDs are, yes, and obviously it is pretty much fundamentally driven at this point in stage. As I said, the large inflows in metals is definitely supporting the Rand at the moment. We've got a lot of good things happening within our own economy at the moment as well. So that's driving markets at the moment, additionally on top of that. And there's just a lot that is continuously adding on and adding on, adding on. So yeah, there is a lot that we can do right now. And once capitalizing on anything within that range, so we're just waiting for a break to either side to kind of capitalize on that short-term move within the specific currency pair at this point in stage. Now, again, if there's any questions, please feel free to ask. Happy to look at that, happy to answer. If there isn't, we're going to move on to our next instrument for the day, which is natural gas, which I know is a fan favorite within this group and even with me personally. But natural gas has been looking different over the last 2 weeks. And it's kind of scary different. Okay, so natural gas is currently sitting around $3.80 per million British thermal units, near its lowest level since mid-January. And this has been driven by two specific factors. Firstly, warmer weather forecast across US throughout the rest of February, basically, which is obviously reducing heating demand. Then we also saw, so obviously remember early January, we had that massive spike because of the frost that kind of hit the US. So what happened with that frost? They increased production. So now that rising production with output in the lower 48 states averaging around 107.5 billion cubic feet per day, up from the 106.3 in January, is kind of counterintuitive for the price of natural gas now. So yes, we saw a massive 360 billion cubic feet storage withdrawal during late January when we had that Arctic blast, pushing inventory slightly below seasonal norms. But now expectations for mild weather to narrow that deficit by early March is adding a little bit of controversy. One little bright light, if I can put it in such a way, is the liquid natural gas export demand, which is remaining strong. It's currently averaging around 18.5 billion cubic feet in February, matching record levels and helping limit deeper declines. So this is kind of like a classic little bit of tug of war, okay? Yes, we have weather and production, which equals downward pressure, but then exports and psychological support equals a very hard floor underneath at this point in stage. Now, when we have a look at our charts here at the moment, there we go. We can see that that $3 level at the bottom, which is also close to that mid-January low point, is currently, I would say, that hard floor, line in the sand, and it's also a major psychological level. So if price holds above that $3.80 support where we are at the moment, the next resistance would be around $4.50, which is last week's last week's support here. And you can see week on week, I mean, in the beginning of Feb, we opened with this massive gap, continued down, consolidated again this week, massive gap, and now we're consolidating again. So now the question comes in, after tomorrow's close, do we see another gap lower to this hard floor on in this range here from $3.20 to $3 flat? Or are we going to see a little bit of a rebound with some higher momentum on the specific commodity? And again, pushing higher to then that $4.50 or maybe even the $5.20 level, which is obviously where we kicked off the month of February. Definitely some interesting dynamics to analyze here at the moment. Now, a break below $3.80 clearly opens the door to $3 at this point in stage. As you all know, natural gas is rarely a boring commodity, but it is often a very, very choppy one. And in this environment, that seems to be exactly what we are getting right now. Please let me know if there are any questions on this analysis. If there are, okay, I'm not seeing anything right now. I'll be happy to look at that for you as well. So please pop through any questions for me. Before we do go, let's pop down to a lower time frame to see if there are any intraday. And we can actually see here literally every day there's also gaps, gap lower, gap lower. That's obviously where we kicked off. So there's Monday, gap lower, Tuesday, gap lower, Wednesday, gap lower. So been a relative amount of consolidation, no clean setups, but if this trend kind of continues, could be a good assumption that obviously with tomorrow, there could be another gap lower with a break and then a move down to that lower level here in early Monday morning trades. Again, just basing that off price action that we are seeing here at the moment. But a break above this $4 level could actually lead to a retest back up here at $4.50. So let me know your thoughts. But what do you guys see? Do you agree with what I'm sharing here at the moment? Yes, no, maybe. Would love to hear from you guys. But with that being said, let's finish off the day with equities. And more specifically, as I stated in the beginning, S&P 500. Now, this index finished flat yesterday after initially rallying on stronger jobs data, then pulling back as treasury yields climbed and rate expectations were pared back. Now, as stated a little bit earlier, non-farm payrolls came in higher, unemployment came in lower, and these were solid numbers. That reinforced the idea that the Fed may keep rates on hold with the next cut pushed to July. But here's the interesting part. Despite the late session pullback, 8 of the 11 sectors within the S&P closed higher. This was led by energy, consumer staples, and materials. So under the surface, breadth, if I can put it say, was constructive. So we are also in the heart of earnings season at the moment. We saw earnings results from Cisco, McDonald's, Blovin, and this obviously created various movements within the market. Cisco fell 7% in extended trading. McDonald's was muted despite beating expectations, and AppLovin slipped after hours. So the index isn't directionless, it's just selective right now. Now, if we have a look at the charts right now, it's a very, very interesting picture looking at this specific index at this specific point in stage. So that big level everyone is watching right now is definitely the psychological 7,000, where we are currently at that 6,960 area. And support is currently sitting here at 6,910, which has been heavily defended over the last couple of sessions. And this is obviously followed by that lower level at 6,820. Now, the market has been stuck roughly in this 200-point range at the moment since the start of the year. As traders, we kind of need to look at this chart right now and ask the following question. Does earnings season provide us with a catalyst to break above 7,000, or does the higher for longer rate thinking keep momentum relatively capped? Because 7,000 gives way decisively to the next reference, which would be our extension level at 7,200. So that would literally be up here now, which becomes our next target level. So at this point in stage, literally just waiting for a break higher to kind of give us that next catalyst and our next move upward. Now, looking at some lower time frames, if we're looking at just some day trades right now, if we can keep some solid momentum here and maybe just a break, I would say slightly higher or even a little bit of momentum on here, there could be an intraday higher position, maybe with an entry here around 6,970, relatively tight stop, maybe here around 930, and then just a one-to-one push up to the resistance. If there's no clear price action on this and it breaks back below our EMAs again, 30-minute EMAs are nice and bullish, hence why I'm kind of aiming for that one-to-one trade at the resistance. But if we do get a break lower with a little bit of a retest, that could lead to a support down, a retest of the support down here at 6,820. Obviously, once we get to that resistance and we break above that psychological 7,000, that kind of opens up this index to rocket to that next level, which is sitting at 7,200. I do see I have some comments coming through. Would change in weather give some more confirmation for natural gas? Yes, absolutely. So remember, this is one of the major catalysts driving natural gas right now. So first things first, like I've always said to you guys, if you are trading natural gas, you need to have one eye on the weather channel at all times. Okay. Because if we get colder weather in the US and anywhere relative northern hemisphere, which is major consumers of natural gas, this will automatically cause a rebound in natural gas prices. So, other words, causing natural gas prices to go back up. Now, as we are getting to the later part of the northern hemisphere winter, if we have warmer predictions, so again, have a look at the weather channel. If there's warmer predictions for the last part or the last stretch of the winter, and again, when I'm talking warmer predictions, I'm talking warmer prediction based on previous year averages. That would just cause natural gas to keep going down. So absolutely, absolutely, changes in weather will definitely affect the price of natural gas at this specific point. So, really good question. In summary, I agree with all your analysis. Oh, I appreciate that. On all the pairs you covered, thank you. Absolute pleasure. Only a pleasure. So, traders, as we are finishing off this session now, please remember that tomorrow all eyes will turn to the US CPI report. So we've had stronger jobs data now. Yields have moved. Rate cuts expectations have shifted in July. Now inflation gets the microphone in essence. So if CPI surprises tomorrow, the question becomes, does it validate the Fed's patience or reignite rate cut optimism? Because in this market, data isn't just data anymore, it's fuel. And with that, we wrap up today's market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. So if you are not trading with ATFX yet, simply head over to atfx.com and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.